This is Satya Pradyuman of Cirrus Research. Our latest quarterly outlook is out, the Cirrus Dispatch. The title of it is Soft Landing and Interest Rate Risk Point to a Value Tilt. Underneath this title is really the story of two components of the market that's starting to come together. One is this idea that the profit cycle is starting to stabilize, potentially a soft landing. And two, the very components of a soft landing is really what's potentially driving interest rate risk. As a result, this very sharp rush of growth stock performance, especially the Mega 7 stocks this year, potentially comes to a halt. The idea is that valuations begin to matter if profits begin to stabilize. This chart here really flashes the sort of performance risk of growth strategies as a whole. The blue curve represents the performance of growth strategies over value strategies. So as the line's coming down, it means growth strategies are underperforming value. What you'll notice is the purple curve represents the 10-year Treasury, and as that continues to back up, that is really what's going to put downward pressure on higher multiple stocks. So the idea is not necessarily to become a value manager overnight, but valuations are going to matter more and more as this profit cycle stabilizes. This curve here just registers how far along this cycle has run. Basically, what you've got is a 2-year period in where the profit cycle has really rolled over. So this is the purple curve breaking down hard where it's been slowing. What's important, though, is what we're seeing on the blue curve here, which represents estimates. The estimates have been sharply retraced. That, I would argue, really drove the weakness in the markets in the prior 18 months or so. What we're now starting to see is that the sell-side estimates are starting to ramp back up. So we're not out of this slowdown, but the rate of change is definitely decelerating. And as a result, it does back up this idea that we probably have a profit cycle soft landing underway. And then finally, credit. Credit is sort of like the lubricant for growth. And what we've seen is from the initial really backup in credit spreads where it made funding a lot more difficult, we started to see that ease after the severe hikes or the sudden hikes by the Fed. And what we're seeing now is fairly healthy credit spread costs. The idea going back to the 2020-21 period was that the amount of Fed support that was in the system really pressed these spreads well below where they should have been. So to some degree, we're probably more in a steady state category here where businesses really do have good access to capital. Read this as the profit cycle will continue to run its course. And then finally, how do we put this to work? What this represents really the strategies that we run in various growth strategies, from aggressive growth to GARP to quality growth. And then on the value side, deep value, relative value, quality value. If we're right about this rotation underway, we're going to begin to move away from the quality growth strategy, which works when the profit cycle is really, really breaking down. And we're going to move more towards a more valuation-sensitive growth market. The idea is that if the profits are more abundant, valuations are going to matter more. Same here with the relative value. On the value side is that we're moving away from the higher multiple components in the value strategy towards a more relative value position. Take a look at the full report. It's chock full of some of our best comparisons across several of the last few months. With any questions, feel free to reach out to us. Thank you.